Today I'm going to answer the question of whether you should start investing or not. Spoiler alert, you should be. We live in times where we all have mobile phones, making it possible for anyone to invest at just a few taps. You don't need a lot of money to invest and build wealth, as you can literally start with a couple of pounds. In this video, I'll give you all the information you need and a walkthrough step-by-step guide with how to get started with investing. I'm on my own investment journey, and by no means am I an expert, and this is definitely not individual financial advice, but a guide to show you how to get started, as taking the first step is the hardest part with investing. My finance is filled with confusing jargon which puts everyday people like you and I off investing, which is why I started this channel, to share content that is simple and shows you the practical way to win with money. I've separated this video into chapters so that it's easy for you to skip to which section you think is relevant to you. Now, if you do find this video useful, please consider subscribing to my channel, as it helps the information and content I create reach more people and lets me know that the hours I put into researching and putting this video together is worth it. So, what is investing? Put simply, is putting your money into something in the hope that more money is going to be generated in the form of profit. Now, investments can include buy-to-let property, buying vintage cars, collecting valuable Pokemon cards, or investing in the stock market. In this video, I'm going to focus solely on the stock market. So investing is about looking forward. It's making a conscious decision to grow your money. You may not think you're investing, but if you're putting money into a workplace pension, that money is being invested in the stock market. The national insurance that you pay every month to one day use as a state pension is also being invested in the stock market. And investing is different to saving, and it's important to remember that. Saving is putting money into a bank, earning a modest interest with very low risk, and it's generally for the short term. Investing is buying real assets with your money, and generally for the mid to long term. So, how does the stock market work? The stock market is the name for a group of exchanges where parts of companies are sold. You have definitely heard of some of these exchanges, such as the London Stock Exchange, the Nasdaq, or the New York Stock Exchange. Exchanges are basically just supermarkets filled with stocks on the shelves where people can go and buy and sell them. Now, a company may decide that it wants to float on the stock market, and this is called an IPO, or an initial public offering. It's what a company can do to raise money to grow and expand by offering a portion of their business to investors to buy. These investors can sell that stock to other buyers when they want it at a different price, hopefully at a higher one. And that's how you make profit. So when you sell a stock, you aren't really selling it back to the company, you're selling it to another investor. The price of a stock is governed by supply and demand. It's more of a reflection of how people perceive the business rather than how the business is actually doing. Now, there's more to the stock market than this, but let's just stick to the basics. So let's talk about risk. Firstly, you need to know that when you invest in the stock market, your capital is at risk. Now, this means that as well as having the potential to make a lot of profit, you also could lose a lot of money too. Now, this is the main reason I hear for people not wanting to invest, but can risk actually be the reason why your money can make money in the long term? With higher risk comes potential for higher rewards. Now, this is actually the driving force for the money within the stock market. Now, this is called volatility, which is the fluctuation of the stock price that you see day to day. And as you can see the difference, this is what it looks like over the long term, and this is what it looks like day to day. You need to take a step back and take a bigger look at the picture in front of you. It is about time in the market and not timing the market. It's about having the nerve to not sell your stocks when the market crashes is what separates the winners from the losers. A lot of people make the same mistake of buying high and selling low. And a great example at the moment is crypto giant Bitcoin. There are countless stories of people buying Bitcoin when the price shoots up overnight, and 2 days later, after the price plummets again, they sell out of fear of losing all of their money, only to look at the price again in a week and find out it's skyrocketed even further than before. Now, the point of that example is to show you that people invest with their emotions. This is the reason most people lose their money within the stock market. And as you can see, you need to take a step back and look at it from a bird's eye view, and not the day-to-day swings that you can see if you check your account every single day. What do you think you could emotionally handle looking at your balance and seeing it's dropped by 40% in value due to a global pandemic? Are you going to be able to stick it out and wait for the market to recover? Because it always does. What is diversification? Diversification, when it comes to investing, basically means spreading your money out and not relying on one thing to do. It's not putting all your eggs into one basket. By doing this, you reduce risk. Now, this can average out returns across the long term and reduce overall volatility. So you can Diversify your investments by investing in different sectors, different locations in the world, or different asset classes. Now be careful though, over diversification as you spread your money too thin is not a good thing. Now yes, this may mean you lower the volatility, but your returns will suffer as you wouldn't have put enough money into the investment for it to grow over time. Okay, so what is an asset class? An investment portfolio represents the set of assets that an investor holds. Basically, you can think of a portfolio as a shopping basket, and the asset classes are the groceries. Everybody's basket looks different, and there's no right combination of these. Only the mixture that fits your goals. So, what are some of the asset classes? Firstly, let's have a look at cash. Cash isn't usually really thought of as an asset, but it is an important component of a portfolio. It is used as a cushion in times when other assets are underperforming, and it's also there to be used as an opportunity of fund should something arise, such as Bitcoin share price plummeting and you want to get on board. To clarify, I'm not telling you to invest in Bitcoin. You get the idea. Shares, also known as equities. Now, shares are bought and sold through brokers or platforms that handle the transaction on your behalf. Now, they make their money by charging a fee for buying and selling within the stock market. So when you purchase a share, you actually own a piece of a company. Now, when you own enough shares of a company, you can actually sit on the board and vote on future decisions. So you can do this in two ways. You either own individual stocks within the company or you buy an index fund. Now, an index fund are collections of stocks that are categorized in some way, either by size, sector, or location. Bonds, also known as fixed interest securities. Bonds are sometimes known as fixed income or fixed interest investments too. Essentially, when you invest in a bond, you're loaning your money to a government or company that needs to raise money. Now, this is usually done for a fixed period and you're looking to get returns in the form of interest, which is also known as a coupon. People tend to invest in bonds when they're looking for a low risk investment and don't want much volatility, often leading up to retirement so that they know that their pot of money is stable and predictable. There are other asset classes such as property and commodities, but today we'll focus on the stock market side of things. What is day trading? Day trading is a type of investing that requires rapidly buying and selling stocks on a price swing. It's a very, very risky way of doing things. This is trying to time the market by buying low and selling high, which is something that human beings are just not good at. And this type of trading is responsible for the often quoted statistic that 90% of people lose their money in the stock market. This is the type of stock market investing that you will see in the movies, and this is what most people picture when you think of as investing. We as humans act on emotion. Instead of buying low and selling high like you're supposed to, we panic buy when stocks are hot and sell the second they crash. Which leads me to the most successful investor of all time, Warren Buffett. And this is what he has to say. By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. So what Warren is talking about here is known as dollar cost averaging. And this is what most people should be doing within the stock market. By using this method, you smooth out the bumps by putting money into an index fund every single month, irrespective of the price of the share, which averages out the cost of the stock price over a long period. When the prices are up, you get less bang for your buck, but when the stock market crashes and everyone else is panicking and selling, you're buying shares at a massive discount. Active versus passive investing. Active investing, as its name implies, takes a hands-on approach and requires that someone act as the role of a portfolio manager. The goal of active management is to beat the stock market's average returns and take full advantage of short-term price swings. It involves a much deeper analysis and the experts to know when to pivot in or out of the stock market. You will often pay high fees for this, and the truth is most active investors do not outperform the market, but it's nice to think that you might do. Some people like this approach. For me, it's not the way I want to do things. Which leads us to passive investing. If you're a passive investor, you invest for the long haul. Passive investors limit the amount of buying and selling within their portfolios, making this a very cost-effective way to invest. This strategy requires a buy and hold mentality. This means resisting the temptation to react or anticipate the stock market's every next move. This strategy blends perfectly with dollar cost averaging. Okay, so now we've learned a little bit about investing, let's see where we go to do it. Firstly, we need to choose an investment platform or app. Now there are plenty to choose from, which makes it pretty confusing. The big thing to think about here is fees. Fees eat away at your investment pot over time, which is the compound effect working against you. Some companies will charge you a monthly flat rate as well as a fee for dealing every time you buy and sell a stock. Most platforms are easy to set up, and nowadays it's all done online, and many platforms have gone app only. I won't go through all the different platforms now, but I'll create another video in the future to go deeper into each one. Personally, I use Vanguard to invest in index funds, and I use the investment app freetrade to buy a dividend stock portfolio. If you want to start investing with freetrade, follow my link in the description box below to sign up, and you and I will both get a free share with up to £200. So today we'll be looking at Vanguard as our platform. Okay, so now we have chosen our platform, we need to decide what type of account to invest in. As you can see here on Vanguard's website, there are a few different platforms to choose from. First of all, we have an ISA, or an individual savings account. An ISA is a tax wrapper and is the first port of call for where you should be putting your investments. Money put into this account is post-tax, and at no point in the future will you be taxed. Now, as of January 2021, you have an allowance of up to £20,000 a year to put into an ISA, and this is the allowance for all ISAs, meaning that you can spread your money out across the ISAs, or you can put it into one. Now, most banks, investment platforms and apps offer ISAs now and offer a big range of stocks and funds to invest in. The great thing about investing in an ISA is that you'll never be penalised for withdrawing money. A SIP, or a self-invested personal pension. Now, a SIP is also a great way to invest, as it's also a tax wrapper like the ISA. The money you put into this account is pre-tax money, meaning that you'll have a bigger pot of money to build up using the compound effect over time. So if you are employed, your employer will actually get tax breaks for putting money into this account for you. And if you have a different pension with your employer already, or you're self-employed, the government will top up this account for you in the form of tax relief. This is literally free money, and you'd be silly not to take it. The current annual allowance for a SIP is £40,000 a year. And then we have a general investment account, also known as a brokerage account. Now, a general investment account is another account you can invest inside of without the tax benefits of an ISA or a SIP. So you really should be putting your money into those first, using up all your allowances. Or if you really want to invest in something that aren't available in these other accounts, you can use this one. Now, some people hold investments in this account until their ISA allowance for the year starts again, and then they transfer it across. Personally, I use this account to build up a dividend portfolio with the hopes of in the future receiving a bit of income. The current annual dividend allowance without paying tax is £2,000. There is no limit to how much you can invest with inside these accounts, but profits will be subject to income and capital gains tax. And if you're new to investing, I suggest using a stocks and shares ISA first. And if you don't have one, I urge you to get one today. I also have another video which I'll link to above here that walks you through a bit more detail how to set up an account with Vanguard. It's important to note that Vanguard state that you need to start with at least a £500 lump sum or set up a £100 monthly direct debit. But when I started this, I found that was quite high, so I set up a £100 direct debit and I actually lowered it to 50 within the settings. There was no issues with this whatsoever, and I've actually looked it up, and a lot of people have said the same thing. So do it for short term if you need to, but try and get up to £100 or above. Okay, so now we're into the good stuff. What do we invest in? To put it simple, index funds. Vanguard have ready to go off-the-shelf funds called life strategy funds that diversify your money by spreading it around different asset classes and locations. Have a look at the breakdown on the screen now of all the investments within the fund. You can choose your share bond ratio, which is set out quite clearly in the title. I invest in the Life Strategy 100 fund as I plan to be very aggressive with my investments, and I have a long-term plan for my money. I have a direct debit set up every single month to go into this account, and remember, dollar cost averaging. Choose a fund that matches what risk you want to take. If you want to be more conservative, go for a more bond heavy, closer to the Life Strategy 20, or if you want to be like me, pretty aggressive, go for the 100% equity fund. And away you go. You need to be consistent now. Make sure you try and increase the amount you invest whenever you get a pay rise or a lump sum coming towards you. The compound effect over time will leave you with a nice pot of money to retire and live off, or do whatever you want with. The time to start investing is now. Remember, it's not about time in the market, it's about time in the market. So to recap, choose a platform with low fees and invest in low cost index funds within an ISA or a SIP. Choose a fund that suits the risk you want to take. Set up a monthly direct debit so you take advantage of dollar cost averaging. Try to increase the amount you invest whenever you can, and review your account every month. Don't check it every day, and think long term. Thank you very much for watching my video today. If you like this video, please give me a thumbs up and make sure you hit subscribe. When you subscribe, I know that you guys are enjoying these, and I'll put out as much information as I can.